Hello everyone, how's it going? So in this video, we're gonna go through SOFI Technologies, trading under the ticker SOFI. As one of the most volatile and at some point a very bullish stock during the peaks back in 2020 and 2021, SOFI definitely has been on a lot of people's radar. As one of the most fleshed out fintech enterprises out there, SOFI has accomplished something that a lot of other fintech companies either couldn't do or didn't bother to obtain: a bank license. With that key document at hand, SOFI stands as one of the most fleshed out and comprehensive fintech companies out there. With that being said, the recent stock performance of SOFI followed the market trend overall down. Nevertheless, many people are still interested by, eventually having a position in SOFI, and a lot of people are also willing to ride the long run. So in today's video, we're going to take a look at SOFI and try to work out if you should buy its shares. As always, if you like what I do, please consider to drop a like, subscribe to my channel, and check out the links in the description. So SOFI is a fintech company aiming to become a virtual bank for users seeking more functionalities, flexibility, and competitive fees. People's needs have changed over time regarding how and where they want to manage their money. SOFI has identified this opportunity to do better than traditional banks, offering a scalable and consistent quality of service for its users and clients. Unlike many other fintech companies offering different parts of what a bank's functionalities are, we should point out that SOFI tries to bring all the services under one single umbrella platform in order to optimize acquisition cost for each product. So the company excels in areas of loan refinancing, personal banking, and wealth management. It has been recently under some selling pressure due to the student loan moratorium, and with that also went away most of the gains from the bullish period, and then some. However, it should be mentioned that despite the challenging environment of the economies around the world, it's not just bad news for the financial institutions like SOFI. People are more aware of the need to reduce their spendings. One of the places would be the financial fees. Traditional banks tend to charge much higher financial fees because they have higher operating expenses. And many are looking for alternatives, given that a recession forces them to, be more aware of where they put their money into. SOFI might be one of the companies that can satisfy this need. This is also one of the reasons why we have seen its customer deposit amount increasing. Another factor to consider is the ongoing quantitative tightening and especially inflation. Inflation is high due to external reasons. But as far as SOFI is concerned, they can use this money to make more interest income. Overall, SOFI has been growing on a year-to-year basis, although the progress has been slowed down in recent months. This might be caused by economic downturn, which puts pressure on all the businesses. So even though there is some unfavorable headwind, the fact that they still manage to grow is a testament of the brand recognition and attraction that it has on potential customers. Because of regulatory and economic reasons, SOFI saw its student loan and home loan amounts decreasing by 51% and 73%. This has been compensated by the fact that the personal loans increased by 71%, resulting in an overall increase of lending on a year-to-year basis. On Tuesday, SOFI's share price closed on $4.32, at a 5% decrease compared to where the stock was the day before. Over the past 5 days, it went down by 0.4%, which is a sign that the sell-off is still going, but relatively slow. We can say with a decent degree of confidence that the worst of the market correction is probably behind us, and that whatever further corrections there is, the region between $4 and $6 is a solid support region. So with that being said, it's not guaranteed that the bulls are willing to come back anytime soon, because lots of people assume that the worst of the market corrections they haven't started yet. Overall, the short-term stock performance does give us some reassurance, especially considering that the external context is relatively poor and challenging. In terms of longer-term price actions, it's been like any other major growth stocks, to be honest, which is disappointing. The stock went down by 70% since the beginning of the year, mostly caused by the moratorium, which is a big chunk of what they used to make. The information that is available on the subject suggests that the education department has extended that moratorium to January 2023, and this means that there will be additional needs for student loan-related financing services in the years to come. With that being said, it's worth mentioning that the personal loans have already filled the gap left by student loan and home loan combined, which does compensate for the loss. What also brought down SoFi stock price, and arguably keeps it down, is the fact that it is a small boat in an ocean of bearishness. The Nasdaq, much like many other major indexes around the world, have now lost most of the gains made during the 2020 and 2022 period. This would suggest that the market has come back to the prediction that by the end of 2019, we would probably gonna start to go into recessions, but without the worries of the additional worries of inflation and armed conflicts that we have right now. This is why the probability of entering in a recession in 2023 is beyond high, which would bring the valuation of many securities, but especially the growth stocks, even lower. So basically what lies ahead for SoFi is the possibility of a partial recovery of the student loan business. But we also need to see some market-wide pressure to be relieved for the situation to fundamentally change. With that being said, let's also take a look at its books and to see what the numbers are telling us. As far as profitability is concerned, they have a net loss from the operations if we include the non-cash transactions and the non-operating expenses, mostly interest expense and equipment amortization. What's the equipment, you might ask? Well, the computers. So, on the other hand, SoFi is yielding positive gross profit that grows across the past quarters, which is definitely something that's very encouraging, and it shows the validity and the scalability of its business model. The one challenge that SoFi should address is the cost control, especially when it comes to operating costs. I do expect the spendings to be under control eventually, but not for the next few quarters. Another aspect is leverage. SoFi has a high degree of leverage, just like any other fintech companies. This is normal given the industry that we're in. Nevertheless, we got to be aware that the current level of debt might cause some issues down the road, which is already showing given that the equity of SoFi has been reducing in size over the past 3 quarters. This is a sign that funds borrowed might not have been used at maximum efficiency. The third aspect to look at would be the cash flows that its operations bring in to the table. And in this aspect, SoFi is doing a decent job. The free cash flows, as well as the cash flow from operations, are positive, meaning the company is self-sustaining in terms of cash reserves, bringing down the possibility of additional dilutions. When we take a look at the company's ratios, it's not difficult to see that SoFi has been lagging behind in its portfolio, with almost every single valuation ratio going backward over the course of 2022. What this means is that it's not growing as fast as it should be or as it wished that it's going to grow at, which is normal given the current market conditions being kind of difficult. Nevertheless, we should be aware of the fact that SoFi is losing value on paper and that we should see whether the situation can rectify itself in 2023. Regarding the company's profitability ratios, what the numbers suggest is that things are being stabilized, and from one perspective, even going above the break-even line. In that sense, it's definitely an improvement over time, We should see whether SoFi can control its costs in the years to come, and for now, the gross margin as well as the EBITDA are what matter the most. So we can also take a look at the shareholder composition. 36% of its float is owned by institutional shareholders. This is significant, but it also shows that the vast majority of its shareholders also remain retail. This means that it would have a fairly volatile shareholder base. It tends to trade in and out of positions based off rumors and short-term sentiments. With that being said, even with 36%, the investment into SoFi is or could be a viable option. We should point out that around 38% of the stock is owned by insiders, which to me offers an additional layer of reassurance. So regarding the short sentiment, about 12% of the volume is going to the shorts with 2.4 days to cover. This is significant, but it also shows that it's below the 20% of short interest. So I believe that the short squeeze should not be the main motivation behind buying SoFi shares. It's definitely a stock that has a lot of potentials going forward, and it's a company that deserves a place in our portfolio for the years to come. I believe that it should be bought, for the purpose of investment and ignore the short-term volatilities. So the current price point can be a decent entry point, and I do believe that going forward, we're going to have even better opportunities to dollar average down. My recommendation for exposure is between 3 to 5% of your portfolio spread over maybe like 12 months.